Well, good morning, everybody, and welcome to the first call of 2022 for Haase Family Advisors. We are looking forward to our three-peat of Nick Lacey. Nick Lacey has been with us every January to tell us about what's coming up in the year, and coming off the past year, there's a lot to think about and talk about. So we look forward to hearing his views. Nick, we're going to go ahead and turn it right over to you. Good morning.
All right, perfect. Good morning. I look, having me once is a lot. Having me twice is just, but three times, I'm a lot to take just once. So I appreciate it. And because of that, what I'll do is I'll be succinct and go through maybe 20 minutes of information that I think is pretty useful. Some of it's stuff we talked about last year, but it's good to kind of revisit these things because I do believe that it's important to have a base of what I want to talk about. So I'm gonna show a couple of slides, and this is updates of what we went through last year. I'm gonna tell you what I told you last year, and then I'm gonna talk about what ended up happening, and then I'll give you my thoughts on this year. I'm not gonna spend a lot of time on myself, just understanding that my job at Raymond James is to help provide an outlook for the investment environment. So where are the opportunities, where are the threats, et cetera. Talk about things about risk management, which we talked about last year, but discussing those things more. Portfolio level positioning, where were some of the opportunities last year, where were some of the opportunities this year, and we'll try to hit some of those big questions along the way. What I did want to point out is this is my 25th year now of doing this, not this specific thing, but just in the markets professionally. And my constant reminder to individuals who are participating in the market is there's no secret to the market. The real secret is the fact that the markets go up 70% of the time. We feel like they go down a lot more than that, but every time the markets have ever gone down, they've always gone back up again. It's just a matter of duration. How long does it take for markets to recover? The more diversified an investor is, the less time it takes to recover from major market pullbacks. And in the first quarter of last year, we had a major, 2 years ago, we had a major market pullback. And long-term, it looks like a blip, but at the time, it was a pretty big pullback. We also had a bad January. Now that we've pulled past that and we can talk about it, as a reminder, one of the things that we talk about when it comes to risk, we always talk about volatility, and I have to scratch my head when I think about volatility because I've been doing this way too long to think to myself that just because they taught us in school that volatility is a risk, that investors don't always think of it that way. But I want to mention volatility, and volatility is simply how much something goes up and down. And something that goes up and down a lot is more volatile and more risky than something that doesn't go up and down as much. And a way to measure that is something called the VIX, the VIX, and that is an options-based index that allows us to get a look at the next 30 days of market implied volatility. And the only point I want to make with this slide is there is a black line that I labeled average, and it's the average since 2000. Actually, this is an average since 2000. I only show since 08 on here, but it goes back to 2000. And what we should understand is that the market is never average. It's never average, right? It's either below average or it's above average, because that's how you get to an average. And when things are above average, we say they're risky. When things are below average, we say they're less risky. The reason I take exception with this is because for the most part, over the last 2 years, market volatility has been higher than average, but markets have gone up a lot because we don't differentiate good volatility versus bad volatility. It's indiscriminate. That's why I pointed out as be careful when people tell you higher volatility in the market is bad. It can be. Normally when something bad is happening, it's coupled with high volatility. But when I think about what is a bad market, I think about if something were to go wrong, how much am I likely to lose? Because that really hits my wallet. I want to understand its impact on my retirement plan or its impact on my investments overall. And an easy way to look at that is simply looking at when the market goes down, how much does it normally go down? And what are the consequences for all these other markets? And I did a quick sneak peek of the last 30 years, and I looked at just monthly returns. And I took the worst 18 months going back 30 years and I averaged them together. And what I found was, no surprise, a bad month is when the market in the US is down around 9%. Now, does that mean it's not down more? No, it's just an average. Sometimes it's down more, but 5% of the time, the market drops about 9% in a month. And by the way, during the month of January, we about got to that point. Now it recovered at the end of the month, but January was not a good month. Theoretically, when you look at all the other all the other components of a portfolio, you can get some estimation of what's likely to happen if those losses continue. For example, in a bad environment, we typically see companies that are small, so US small caps, emerging markets, typically have done worse during major market pullbacks. International investments or real estate investments are about the same loss. So you're really not looking at any more greater downside by owning real estate stocks or by owning international developed stocks. Therefore, it becomes about returns. Historically speaking, dividend stocks have done better during most pullbacks, not so much the last couple of, but they did this January. If you want to know what typically does well when markets go through a major pullback, it's treasuries. Now, this January, treasuries were down a couple percent because the markets were pulling back because of what the Fed is likely to do. Now, so there was a little bit of a mixed message, and we'll talk about that. But this is kind of normality. Therefore, if somebody were to tell me, hey, the markets are down 23, 25% from peak to trough, what do you think my portfolio is going to do? The answer is it depends on how much equity you have. And at the end of the day, balanced investors, 60, 65% of them in stocks and the rest in bonds, market down 23, 25%. Balanced investors are probably going to be down anywhere between 14 and 16%. That would be considered normal. Anything more than that would be considered abnormal. So these are some of the things that we're paying attention to. And the reason that I bring this up is if we look at the first quarter of 2020, when the pandemic hit, and we look at the pattern of losses during this major market pullback, the market was down 20% in the first quarter. What was down the most? Small caps. What was up the most? Investment grade bonds. And this kind of follows the normal pattern of what we see throughout history. The issue that you run into is that bonds don't make much money. Therefore, some people like to buy junk bonds. The problem with buying high yielding bonds or junk bonds, you might get a bigger yield, but it acts like a stock during major market pullbacks. And you have to make sure as an investor, you're comfortable with how much money you're likely to make. Because remember, with junk bonds, you're going to earn at best your yield. That's your best return. Your worst return is going to be something less than your yield. And those are things that we have to take into consideration. And it becomes problematic because junk bonds do not hedge against dramatic market decline. So these are a lot of things that we're thinking about all the time. So going forward, what are some of the things that we're thinking about? Well, we can't have a conversation without talking about COVID because it is a permanent part of our life. However, there's good news and bad news with this. What I'm showing on the screen right now is updated as of yesterday, and it's new cases in the US. And you can see that we peaked at about 1,100 new cases per day on average, which is the most we'd ever seen. So huge number and fast, but those cases have been dropping dramatically. The good news from this data is the cases are dropping dramatically, but if you look to the right, those people who are suffering from major illness or death in relation to COVID is nowhere near the escalation that we've seen in new cases. So the percentage of people being negatively impacted in a bad way have come down for a variety of different reasons. So there's kind of good news and bad news on that. If you look at us relative to other countries are going through the same cycle, whether you're talking about India or the UK, Germany. Now, if I put Japan on here, you see the same thing where they go through an escalation. Usually it takes about 6 weeks to peak, and then it starts to fall back off again. And then global case count had gone up, but it's a fairly consistent pattern. And I think from what we're seeing from the market side is the understanding that while the pandemic is not behind us, a lot of the impacts or the big negative impacts have kind of moved behind us because the markets are learning how to move on. So if you were to ask me, what are the things that we're really paying attention to today outside of what's happening on the COVID side, it's three main things. Now, first of all, it's about the jobs activity. And we had some bad jobs numbers come in this morning, but it's not unexpected. We heard one of the Fed members yesterday basically say, probably going to get some bad jobs numbers because there's a lot of stuff going on, but this is not unexpected. There are two things that I find critically important when it comes to jobs. So first is the unemployment rate. Now the unemployment rate is kind of a double-edged sword because we saw the unemployment rate hit around 15% in May of 2020. And that's the worst we'd seen it in my lifetime. And I'm 50, so just go back beyond that. But what we also saw was the fastest recovery ever in jobs, fastest recovery ever in jobs. And as a matter of fact, we're sitting at 3.9%, which is lower than what the Fed assumes is the natural level of unemployment. The Fed thinks 4% is normal unemployment. When you're below 4, you're below that level of natural unemployment. And the natural unemployment has actually gone lower in years as you get the mobility of labor is so much higher today, especially with the ability to work anywhere. You don't have to pack your family up in a U-Haul and move out of town, at least not as much as you used to. That sounds good. However, if you think about the unemployment rate, picture what this is. They're calling people and they're saying, hey, Brandon, you working? And Brandon says, no, I'm not working. Well, technically Brandon is, but let's pretend he's not. Okay, Brandon, you're not working. Okay, you're unemployed. Are you currently looking for a job? And he's like, I'm living with mom and dad right now. I'm not looking for a job. I'm having fun. Okay, since you're not looking for a job, you don't count towards the unemployment rate. The unemployment rate's a survey. What it does not capture are the people who probably should be working who are not working. So the participation rate is to the right. The participation rate is the percentage of the population of working age that's actually working. Now, this is an interesting story because for most of my career, the participation rate has been falling. So really since about 2000, the participation rate's been falling. It was around 67, which was the highest ever. And then all of a sudden in 2000 and 2001, you had a lot of people retiring. We call those baby boomers, right? Baby boomers started retiring. My parents retired. Actually, my parents retired a couple of years later. But people started retiring in large part because companies were looking to reposition themselves going forward. It was a difficult economy, a difficult market. And we saw a large number of people retire. We saw more people retire than join the workforce. That's why the labor force participation rate dropped down to about 62%. But in the summer of 2015, something amazing happened. We started seeing more people join the workforce than leave. We knew this was coming. The US has the largest percentage of young workers compared to any developed country in the world. We have a very large young workforce. So all of a sudden, the participation rate started ticking higher. And that was great because that leads to higher economic activity. And then the pandemic hit and the floor dropped out, and you saw the participation rate drop to about 60%. It's ticked higher since then, but it's still only at 61.9%. That data needs to get better. So if you were to ask me what's going to be the biggest driver of economic activity for the next 12 months, it's going to be the pickup in the participation rate. And there's a lot of things that have to cause that. But we're estimating that this year, you're likely to see double the normal economic growth rates compared to what's expected long-term. Long-term is 2%. So the Fed expects 2% growth in the economy long-term. This year, we're likely to get something closer to 4%, which is, by the way, is a lot less than last year. But last year, we were bouncing off of a recession. So you got recovery built into that. So to me, the jobs data is extremely important. And we want to watch both of these data points. The second thing to watch is where are we in the economic cycle? Now, this is hard to know because the economy is huge. We don't really know what's happening until 90 days after it happens. So we rely on a lot of high frequency data to give us an indication. The first is called the leading economic indicators, LEI. And the leading economic indicators is a basket of high frequency data points that gives you an idea of where the economy is trending in the next 6 to 12 months. And what you want to see is the economy expanding. So you want to see something above zero, which we are above zero. But you also want to see the change of change or the delta. Are we accelerating or decelerating? Are we growing at an above average rate or below average rate? And right now, we've reached peak growth and we've been coming down from that. Well, we know that, but it's still looking like the next 6 to 12 months are going to be substantially higher than long-term trend or long-term normal, which is good news. But remember, we're decelerating. So don't expect this year to have a 6 or 7% economic growth. It's not going to happen. 4% is a great year. On the right is a different way to look at it. It's the Purchasing Managers Index, which is a survey of thousands and thousands of companies, both in manufacturing and non-manufacturing, to basically say, do you expect the next 6 months to be better or worse for your business? And it's a gauge. 50 is the cutoff. So anything above 50 means you expect it to be good. Anything below 50, you expect it to be bad. And right now, everything really is pointing to strong economic activity over the next 6 months. Now, it's off of its highs, but we know that because we came off of really low levels. Anything above 50 is good. So the economy looks like for 2022 that we are going to grow at above average levels. However, the monkey wrench that is in all of our plans, oops, went too fast, went too fast again, is inflation. And inflation is the one thing that we really have to get a handle on. There are two things when it comes to inflation that the markets care about. There's the expected inflation and the unexpected inflation. The expected inflation is what I show on the left. And that is a data point called break-even inflation. And it's what is the market anticipating or pricing inflation in for the next 5 years and the next 10 years. So if you look at break-even inflation, it's pricing 5-year inflation at 2.8%. Now, does that mean over the next 5 years, we're going to average 2.8%? No, the market's not going to get it right. But the more important part is the market thinks the next 5 years is a higher inflationary environment than the last decade. Is it going to be 2%? Is it going to be 3%? Is it going to be 4%? The answer is it's going to be higher than it has been. How much higher is what the Fed is debating and what the Fed is worried about. If you ask me for what I think, somewhere between 2.5% and 3% over the next 5 years is probably what we're going to average. And we'll talk about why. How has inflation actually come in? Well, the personal consumption expenditures, which is the thing, the PCE that the Fed watches, came in at around 5%, which is huge. The consumer price index, which is kind of what the market talks about, very similar, came in at about 5.5%. Now we're seeing inflation at 39-year highs, which we know they're really high. And I'm going to talk about two reasons why. First is going to be the money side. And if you think about the money side, there's a lot of money in circulation. This is what I hear economists talk about. It's the government's issued a lot of debt. We've printed a lot of money. There's so much money in circulation. We've got to have inflation. And maybe, but I'm not really seeing that. The money supply growth has been big, but it's come down a lot. Or you hear over the last decade, I've heard this ad nauseum, which is the amount of government debt is huge. It's going to cause inflation. It's bad. Yeah, government debt's bad, but if you think about it from this perspective, what's worse, the size of the debt or the amount of interest that we're servicing the debt? So from an analyst perspective, we care about our servicing of the debt. How much are we paying to service our debt? And the trivia question that I would offer is, what do you think the yield the government pays on all of its debt? The answer is 2.1%. So we pay 2.1% on our debt. That's a pretty small number. Now we still got to pay the debt back, don't get me wrong, but we've been issuing a lot of longer maturity bonds. In order to pay back 2.1% interest, our economy plus inflation has to grow more than 2.1% a year. Is that likely to happen? Yeah, that's likely to happen. So why don't we have a debt problem today? Because inflation, while high, isn't necessarily bad for government debt, as long as interest rates stay low. The problem will be if interest rates rise too much. Then all of a sudden the cost of financing goes up. The other thing that I've heard mentioned is savings. Like, hey, people are saving a record amount of money. When they put that money to work, watch out. That could actually be leading to some of the demand issues where people are now starting to put money to work. But I would argue something different. I would basically say we have major supply chain issues. We've been talking about this now for a year. And there are a number of different ways that we can watch supply chains. But one of them is the cost of shipping stuff across the Baltic. It's called the Baltic Dry Index. It's a level of stress in the system. And we peaked towards the end of last year, and the stress has been coming down, but the stress is still high. The stress hasn't gone away. There's still a problem. Or if you think about what companies are looking at, it's the cost of freight. And general freight, which is just shipping anything, either by truck, by cargo ship, whatever it is, the cost to ship something has never been this high. Or you can look at airfare freight, which is kind of the whole FedEx model, right? Ship stuff by air. It just reached its highest point since it reached in 2014. So it's seen this before, but the general freight is really high. And this is a sign of stress in the system. So we need those stresses to get resolved. The impact on interest rates, municipal bond yields haven't gone up very much. However, 10-year treasury bonds have started to tick higher. And the treasury bonds have started to tick higher because the Fed has made it very clear they're going to raise interest rates. And this is probably the best conversation that we can have. When it comes to the Fed and what they're going to do and the impact on the market, it's all about messaging. What has the Fed messaged and what has the market priced in? So here's my 2 cents. The Fed has made it very clear they're going to raise interest rates starting in March by 25 basis points or 1/4%. They're probably not going to raise rates again until June. All else being equal, that's the data that we're looking at. They could do it in the May meeting, but it looks lower probability, but they could. It looks to us, based on what we see today, that the Fed might raise rates 4 times this year. If the Fed does something other than what they're communicating, the markets will have to respond. So think about it from, you have people out there that are saying the Fed's going to raise rates by 0.5% in March. Yeah, I'm giving that a 7.5% probability because that's not what they're messaging. And if they do that, the markets will react and not good. Right now, the markets have priced in 4 rate hikes this year, each calendar quarter through December, and then 3 more rate hikes the following year. That's kind of what the market's building in until the Fed changes their message. So what has the 10-year Treasury yield done? It's ticked up to about 1.8%, which might seem like, hey, it's moving higher. The problem in my seat is on the right. It's the difference in yields that you're seeing between short maturity bonds like a 2-year bond and a 10-year bond. Now, we call that the slope, but it's really, as an investor, if you're going to loan somebody money for 10 years, you want to get paid more than if you're going to loan them money for 2 years. It's a term premium. It's like, hey, I'm giving you money for a longer time. You need to pay up for that. And when the difference between 10-year bonds and 2-year bonds are really, really tight, it's problematic. This is what we see in the market today, where 2-year yields have risen, but 10-year yields haven't risen very much. So basically what the slope tells us is that the market is giving the Fed permission to raise rates a couple of times earlier in the year and then wait and see. That's kind of what we're seeing, because what the market doesn't want and what the Fed doesn't want is for 2-year yields to exceed the yield on the 10-year, because that's problematic. And I'll quote the original Ghostbusters movie when we say it's like dogs and cats living together, right? It's bad. We don't want 2-year yields higher than the 10-year. It shows that there's a problem in the system. So keep an eye on that. That's what I think the Fed's going to do, because the Fed's trying to fight inflation, but the Fed doesn't want to raise rates too fast because it also wants to boost the participation rate. So a lot of things that affect. If you want to know what we're watching on the equity side, I won't spend a lot of time on these numbers, but it's all about the expectations for growth in 2022 and 2023 for the various equity markets around the world. You want to see good earnings growth, you want to see good sales growth, and you want to see good dividend growth. More importantly, you want to see those things getting revised higher. Right now in the US, we're looking at 9% earnings growth in the US large cap market, which is good. It's about average. Last year, what did we see in earnings growth? 45.5%. That is anything but average. As a matter of fact, when I was doing this conversation last year, here's probably what I said, because I don't actually remember what I said, but here's probably what I said. We're expecting a very substantial improvement in earnings this year relative to normal. As a matter of fact, it's such a huge number, I think it was 25-30% at the time, that it behooves us to own more equity than we would normally own. Therefore, we have shifted from a neutral weight equity to an overweight equity. And did that prove to be a good thing to do? Yeah. So stocks were up about 30% more than bonds last year, because bonds were down a couple of percent. Stocks were up between 25 and 28%. So not a terrible thing. Well, what about this year? This year, it's not going to be so easy. This year, if I were to guess what the markets are going to do, and by the way, I'm going to be wrong because we just don't know all the stuff that's going to be priced in. We're looking at an average year this year for the stock market, which isn't a bad thing. After coming across last year with a 28% return for the US large cap market, that's a pretty good year. So if we have an average year and investors earn 8 to 10%, which is about an average return, I would certainly not be upset relative to the bond market. The bond market's probably going to be down another couple percent this year. It already is, because that's kind of what happens when rates tick higher. So you had bonds down a couple percent last year, probably down a couple percent this year. That's what is supposed to happen. So why in the world would anybody want to own a bond? You want to own a bond because of something really bad. If the markets get punched in the face, because that happens from time to time, you can't predict it. you want to own something that's going to give you protection. Those end up being high quality bonds, but because high quality bonds are going to make you very little over the next several years, you have to diversify and own some other stuff. So we're a little overweight equity, overweight the US markets. At some point, we might neutralize that. We own some credit, things like high yield bonds still, some emerging market debt, some emerging market equity, trying to diversify these things. But this year is not going to be as easy as last year. Last year, all you had to do was own US equity and you won. Large caps, mid caps, small caps, didn't really matter. Dividend stocks, non-dividend stocks. I mean, it's like, it was fun last year. I hate to say that about investing. This year's hard. I don't know what's going to do better this year, US markets or foreign markets. It's because the data's too close. I'm a huge bull for the US because we have a much better synergies between fiscal policy and monetary policy. Doesn't mean the US is going to win this year. I think the difference in returns are going to be very, very tight. Unlike last year when we basically said, here, I'll actually show you. So here was our positioning last year. We were saying overweight equity, overweight the US, overweight US large caps. By the way, I'm not making this up this year. This is actually what we showed last year. Underweight the foreign markets because they're just unattractive. Underweight fixed income, especially investment grade bonds, because, well, they're probably not going to have a good year. And own some junk because high yield bonds were in a pretty good position. And we started adding positions to emerging market debt for fixed income heavy oriented allocation. So that's what we said this year. We're still there this year, but expect to start seeing some changes at some point. Some of the things that we're likely to start recommending and start doing is improving the quality of both the stocks and the bonds. So in the bond market, what does quality mean? Moving more towards US investment grade. Not right this second because the market needs to adjust to Fed expectations. But once the market adjusts to Fed expectations, then you start moving out into some of these higher risk area into safer areas. In the equity markets, it basically means moving up the market cap. We still have pretty substantial exposure to small caps and mid caps, and they're working. Well, except January, they got hammered. But they're working because as long as we're in that economic cycle where we're growing faster than potential, small caps typically do pretty well. But at some point, we're going to want to move that money up the market cap. So that's a little bit about what we're looking at. Am I look at that 20 something minutes. So I went a little bit longer than I intended to, but I guess Stephanie, Brandon, anything that I can hit on that you would like me to spend some more time on while I show the disclosures?
Well, Nick, thank you so much for your comments. I think two things. We ask for questions from our clients, and if they have some after the call, be in touch with us and we'll pass them on to Nick to follow up with. Two, we'll also plan to share your deck that you shared with us today, Nick, in a follow-up email. So that might prompt some additional questions. But I think you did a nice job of covering it. You know, we have a lot of questions going into it. I think January kind of woke us all up. So we appreciate the longer term view of what to expect this year. Brandon, do you have anything to add? No, he's on mute. Great. Well, Nick, we really appreciate your time today. Thank you. Maybe we'll go for a 4-peat next year. I think we should. It's a nice way to set up the year. Thank you to all our participants today. Like I said, please follow up with us about anything that we covered today or anything else. As always, we appreciate all of you. Thank you.
We look forward to talking to you again. I'm gonna get there at some point. I promise, in person.
Well, we'll look forward to it, Nick.
That's gonna happen.
Thanks so much. Take care, everybody.